My name is Michael Gayed, publisher of the Lead Lag Report. Joining me today is Gene Epstein, who I've had the pleasure of listening to some of his prior lectures, and I think this will be a really interesting back and forth. Gene, introduce yourself to the audience. Who are you? What's your background? How'd you get involved with the Mises Institute, and what are you doing now?
Okay, well, briefly, for 25 years, I was the economics editor and economic columnist at Barron's Financial Weekly. I wrote weekly columns and articles about the economy. I left Barron's in January of 2018 after 25 years. Then I've been running a debate society, the Soho Forum in New York City. I participated in a number of debates at my own forum, one of them with a socialist named Rick Wolf, and that's gotten nearly 6 million YouTube views. I also actively tweet. I was doing a number of articles, and so I still follow the economy, although I guess not quite as closely as I did when I wrote about it every week at Barron's. And I'm interested in broader issues of socialism and capitalism. With respect to my involvement with the Mises Institute/caucus, I've been deeply influenced by the Austrian economist. In fact, just this past Saturday, I delivered a luncheon talk as part of the Mises caucus that's taken over the Libertarian Party. Delivered a talk in New York City about Austrian economics and how it differs from the mainstream. And so even though I'm very data-oriented, I do regard the framework of the Austrian economist as vital to my approach to that framework.
Okay, so let's first define for the audience what being an Austrian economist means. That term is thrown around a lot on Twitter. A lot of people reference that when it comes to the cryptocurrency space, Bitcoin. But explain what Austrian economics is.
Well, one way of putting it, as I did when I spoke about Austrian economics versus the mainstream, is to say that if you are an Austrian economist, it's very difficult to avoid being a libertarian. Now, that's a start to clarify things. But more precisely, to contrast the Austrians with the mainstream economists, the mainstream economists, first of all, when they look at the broad economy, they have a very strong top-down orientation. They don't question the importance of the Federal Reserve and the role it must play in the economy. For example, I do believe that they like to sit at the tables of power. It is fun to run the Treasury, as Janet Yellen does. She's an economist. It is fun to run the Federal Reserve, much more exciting than having to sit in the classroom, even though our current Fed chairman is not an economist. Most of the guys who did run the Federal Reserve were economists. But then, in particular as well, the mainstream will say that that your understanding of the economy has to be data-driven, that you look at the data and you draw inferences about economic behavior from the data. More to the point than the Austrians say otherwise. They say that that insights about economics actually come from our understanding of our own human action. And indeed, human action was the title of the magnum opus by the greatest Austrian economist, Ludwig von Mises, who lived through most of the 20th century. For example, we believe in the insights of supply and demand, not because we look at data, but because we have an understanding of how we work with goods and services under conditions of scarcity. The first units of water we drink and we use to put out fires. The next units we bathe in and we swim in. The next units we put along with it. What does that mean? That means that we place more and more units of goods to lower and lower priorities in terms of use. Now, that's a kind of a priori insight, and it explains why, if we have more of a good, the price tends to be lower in order to clear the market. Now, you're not going to be able to infer that from the data because, in fact, if we look at the data, we find that we have more of most things, and yet everything's more expensive. So if it was only the data telling us about what happens when there's more of a good, we would tend to infer the reverse, that more good tends to lead to a higher price, not a lower price. And nobody believes that, because even the mainstream, once they get down to it, will apply the same a priori reasoning to how they think about economics, just like the Austrians will, except they will often pretend that they're not doing so, and they often get tripped over by their own tendency to look at math, and as well by their superficial approach to so many other issues, like, for example, the origin of money, the role of the Federal Reserve. They don't want to think radically about it because they regard that as part of their perks to run the Federal Reserve. So that perhaps captures in a nutshell the difference between the Austrians and the mainstream. As I say, in particular, if you follow Austrian logic about the economy, about money, banking, the Federal Reserve, then it tends to lead to radical free market conclusions about the way the economy should be run.
So I love that point. You have more things and more, and yet the abundance of supply still results in higher prices, which would be the conclusion just looking at the data itself.
Yeah.
I have to assume that a lot of that relates to competition, right? So you might have a lot of supply, but if it's only being supplied by, one or two firms, that explains some of that dynamic.
Well, I would say that that whatever the merits of what you just said, I may even challenge it. Maybe we could talk about that. But really, anybody, even including the mainstream, that they understand that to put it briefly, things cost more because the money supply is expanded. Because it's really the revolution that Milton Friedman tried to initiate 40, 50 years ago, to understand that price inflation is always and everywhere a monetary phenomenon, has been more or less understood by everyone. So even though there are more available to buy, the money supply has expanded more rapidly than the supply, and that's why items are more expensive than they used to be. That's the primary reason. And again, my point is that the mainstream lapses into Austrian reasoning anyway. Milton Friedman, I just mentioned, is a good example. He was, of course, the famous free market economist who had a lot of distance and skepticism, distance from and skepticism about the Austrians. In fact, I spoke with him a few times a year when I was a columnist at Barron's, and sort of befriended him by phone, even though I never actually met him personally. He wrote, Milton Friedman's an interesting case because while he was not the sort of economist to try to think of the economy from a top-down perspective, he did write a methodology paper that was rather bizarre about the methods of economics. He wrote a paper in which he argued that all economics has to do is predict the future, that you look at data, you predict the future, and you don't really have to predict where that data will go. And it doesn't matter if your formulations are invalid. It only matters that your predictions turn out to be true. And he literally used the example of a game of billiards. He said the economist doesn't have to understand how the game of billiards is played. He just has to look at the way the balls move and predict where the balls will move in the future based upon their prior move. Now, this was a kind of a bizarre argument, and it's something that Friedman never practiced anyway. When he reasoned about the money supply and about most other issues that are important with respect to economics, he sounded like an Austrian as well. And so they all lapse into Austrianism. But again, going back to the point, it's pretty well understood that things cost more because the money supply has expanded faster than goods and services have expanded.
So I've used that line before, that it's not that inflation is a monetary phenomenon, it's a leadership phenomenon. Because if you're the head of the Federal Reserve, you have control of that. The incentives are not necessarily there, I'd argue.
Well, actually, that's an interesting, subtle point. I would certainly agree completely that the recent price inflation was a leadership issue, although what's fairly clear, and which I've shown on my Twitter account, which, by the way, for those of you interested, is at Gene Soho Forum, that's named after my debate society, the Soho Forum. that I've shown that data are pretty straightforward, that there was a huge expansion with the lockdowns in 2020, a huge expansion of fiscal spending, which took the form of debt. The federal government was not going to raise the money through taxes. They simply issued a few trillions worth of debt. This debt was then purchased by the Federal Reserve, or to use a verb that all economists use, the debtized. It wasn't so in the market the way you and I would, where corporations, the people who want to own bonds. So the Federal Reserve printed money in order to acquire this debt, and we see that the data from the Federal Reserve economic data released by the St. Louis Fed, which everybody uses, shows a huge explosion in the amount of debt that the Federal Reserve held, to the tune of a few $1 trillion in a very short period of time. And then we find happening at the same time an explosion in the supply defined as M2, which includes not just cash and checks, but what's often referred to as near monies, savings accounts, money market funds. So that M2 also exploded on the charts, unprecedented. If you look at data going back to 1960, it was a huge jump that had never happened before. So there was that chain reaction. Now, getting back to your point about leadership, in a way, the leadership really came from the federal government. And by the way, initially came from Trump, and then Biden picked up the ball. Huge explosion in which the Federal Reserve bought. The Federal Reserve didn't necessarily have to buy that debt. I guess what would have happened had debt been actually released in the marketplace and with an attempt to find buyers for that debt, is that interest rates would have risen. In order to sell that debt, it would have been sold for lower and lower prices against face value, which would have meant a much higher rate of interest. But the Federal Reserve bought it. In that sense, that who was really leading? Well, if we regard the government as sort of like all of a piece, really the Federal Reserve is part of the government, although, of course, factions within government can disagree with each other. But if we think of it as factionalism, then the Federal Reserve, under the current chairman, simply acquiesced and bought up the debt, monetized it, hoping, I guess, dreaming that this would not cause a price inflation. But in fact, that's exactly what did happen, with to no one's great surprise.
Yeah, and I think a lot of people put blame on the Fed in terms of responding too late, but I want to relate that a little bit to your book. I think that was published in 2006.
Yes, I didn't mention my book. I published a book called Econo Spinning in 2006, and several chapters of it were, of course, about Paul Krugman. But what were we going to mention about that?
No, and because I think this is just kind of in general an interesting direction to go, which relates to the name of the Twitter space, the economic data lies. The subtitle on the book is How to Read Between the Lines When the Media Manipulates the Numbers. The numbers are manipulated not just by the media, but by the sources of the numbers, because there's revisions, which is always the challenge to try to set economic policy off of when the data is not accurate when it's first released, right? So first of all, how has economic data and the accuracy of data over time changed? Has it improved? Is it less easier? Is it less easily manipulated in terms of the sentiment? No, go ahead. I just want you to riff on that, because I think comparing, where we are today to many years ago. Yeah,
I have. I might surprise you and say I have some respect for the data, but and I'll elaborate on that in a moment. But to unpack the interesting statements you've just made, my first really is that if you are an Austrian, you understand that the Federal Reserve has an impossible job. It's essentially a Soviet-style planning agency, at least to a great extent, that's what it is. It's supposed to be setting the most important price in the economy of all, the price of money. But I would rather that it get out of the money business and that it set the price of shoes. It would do less damage if it did that. But of course, we also understand that it shouldn't be setting the price of shoes because the Austrian insight tells us that the economy is not to be managed from above. It happens from below. It's the product of thousands of decisions that nobody can possibly rationally follow. Or to go back to a favorite example that goes back to Bastiat in the 18th century, if you're in charge of feeding the city of Paris, you'd have an impossible job, and yet you wouldn't know how to do it because it would be so dauntingly complex. And yet the city of Paris got fed every day because thousands of people were responding to market incentives and responding to what kind of food people wanted to eat. Similarly, the interest rate, short-term interest rates, long-term interest rates, all of interest rates are the function of many different independent decisions being made by savers and investors. And the idea that the Federal Reserve should have, or any centralized body should have any role in setting that price is absurd. And the only reason why the Federal Reserve ever was created was not because there was ever any instability in the economy that only the Federal Reserve could address. The Federal Reserve was in 1913, and the folklore has it that the economy was so unstable, you needed the Federal Reserve to stabilize the fluctuations in the economy. Well, we happen to know now that however troubled, by the way, the economy was prior to 1913, and its trouble had a lot to do with government intervention, by the way. In fact, economic performance before the Federal Reserve began was at least as good or bad. The Federal Reserve improved things not at all, and even to say that, it requires us to forgive the Federal Reserve for the Great Depression, which happened in 1929, 16 years after the Federal Reserve was created. Even if we look at the record of the Federal Reserve since 1971, when the U.S. went totally off the gold standard internationally, the performance of the economy with respect to every possible metric, including the instability of business cycles, is no better. In fact, is somewhat worse than it was before the Federal Reserve was created. The Federal Reserve was really created as a bid for power by the New York banks, and it was also as well created to be the handmaiden of government, so that the government doesn't only have to tax or borrow against taxes in order to finance its operations. The government can use the Federal Reserve to print money. So there's never a good reason for the creation of the Federal Reserve. Now, of course, I'm unpacking so much of what you've said and getting back to the data. Then about the data that you mentioned, revisions, there's no question that there is a real problem with respect to managing the economy based upon the available data, because through no special fault of the data mills, since the Bureau of Economic Analysis, the data is often approximate and often subject to revision. And now that doesn't mean that it's useless data. From the standpoint of me as an economist writing about the data on Twitter, or writing about the economy and the data in particular, Barron's, as long as you approach the data with a proper respect for its inexactitude, you can say something that are of some value about what's going on in the economy. And of course, it's always of interest to know that. It's of interest to me. Of course, millions are indeed interested in what goes on in the economy. But one of the things that I had to deal with when I wrote it for Barron's in particular was that Barron's is essentially read by people who invest in the stock market. I mean, in a way, you're an investor in the stock market, and you're part of about 500,000 people who read Barron's, because the stock market is like a sport to you. It's filled with events, filled with fascination. It's a casino of sorts, but of course, I think it's a sensible casino. It's a sensible mechanism by which stocks are priced. But you're interested in the stock market, and when there's a stock market close, when the Dow Jones or the S&P 500 closes at a certain number, that number has a certain finality in time. It's not going to be revised. And so I had to keep teaching my readership that you have to stop doing what the market tends to do, which is to treat economic data as it's released as though it has the finality of a market close. There was one rather funny, in retrospect, funny moment. I'm trying to remember. Yeah, it was under Obama. I'm forgetting the year, when the very closely watched monthly report on non-farm payroll employment, which also reports on a monthly basis at the same time the unemployment rate, the non-farm payroll employment number was absolutely flat. They reported a zero change in employment. And the papers were filled with the headlines, employment gains grind to a halt. Well, the market was down substantially on that day. The number was released Friday morning, as it always is. It's always on a Friday morning at 8:30, and the market tanked in response. Now, I wrote a column that for Saturday morning, saying that this number could be revised up by 100,000 jobs. It's just the first release of the data. It's not necessarily true. The revisions are too great. The sampling error is too great. There's no point in taking it literally. The way to look at, as I argued at the time, the way to look at the employment report data was to take at least a 3-month moving average, but probably closer to a 6-month moving average, to recognize that this is a series of very out of focus snapshots. Although if you lay a number of them end to end, it will reveal some kind of pattern. But 1 month's worth of just released data is not really going to tell you what's going on. Well, sure enough, over the next several months, that particular number kept getting revised up. So it turned out that the records show that there wasn't actually a greater than 100,000 increase in employment for that particular month. It wasn't zero. And while the 100,000 increase was no great shakes, it was far from zero, and certainly did not justify a sell-off in the stock market, or the media reporting that employment gains ground to a halt. So that's just one particular example of how the data should be used judiciously, even though, as I say, a lot of the data is of some value and can tell you a few things of what's been happening in the economy.
Right. And actually, I think the broader point there is that it's hard for people to think about what a margin of error means, right, when it comes to data when it's first released, and the idea that can be pretty wide, and yet policymakers are still responding off that, investors are responding off of that, and it's not real the real truth of what's happening beneath the surface.
Well, indeed, there are a fair number of sophisticated statisticians at the Bureau of Labor Statistics and Bureau of Economic Analysis, even though I hasten to say that I think that they are somewhat bureaucratic and that therefore they wear blinders in certain respects. But they do have cautionary statements in so many of their releases. They say in particular that the employment data to sampling error and non-sampling error. And of course, the third thing that they don't add is that almost all the data that they release is preliminary and subject to revision. And so they should make that a bit clearer to their audience. Although I think there's a certain ambivalence, and there's a ambivalence in the sense that they enjoy the fact that they're important. I should say, historically, what's interesting is that I started writing my column at Barron's in early 1992. That's just at the point where the markets began to get increasingly in economic data. In the 80s, there was not nearly so much of an interest in the economic data being released. And so they clearly approached the data naively. There's an expression called data noise. And so much of what is released by the Bureau of Labor Statistics, for example, is noisy data, where the sample is so small that any particular month or 2 months or even 3 months worth of data is just noisy. We don't really know whether it's establishing any pattern at all. For example, for the fluctuation in people working part-time. I remember Peter Schiff cited some number that the recent employment data mostly consisted of part-time workers, when in fact he was just citing noisy data that made no sense at all. And if you look back over the prior 12 months, if you look back on 12 months worth of noisy data, the noise can even out. It jumps up, it jumps down, it jumps up, it jumps down. And then, but what does it do on net over a 12-month period? Now, that's not very exciting to have to look back on the past 12 months worth of patterns because it isn't up to date. It isn't current. But you're not going to get anywhere by looking at 1 or 2 months worth of noisy data. You'll only get a misleading impression because it's simply responding. It's a phenomenon of the data. It has nothing to do with the underlying reality. So in that sense, I wasn't exactly, writing for the sizzling headlines because I was cautiously approaching the data with a great many caveats, rather than latching upon one bit of data or another bit of data. I'm trying to remember where Greenspan had egg on his face because he was citing what's called the quit rate. The quit rate is interesting data. It's the percentage of workers who voluntarily quit their jobs, and it is legitimately regarded as a vote of confidence in the labor markets. If a lot of workers are quitting their jobs before they have another job, that implies a certain ground level confidence about the labor markets. But I'm trying to remember which direction Greenspan was citing it, but he cited 1 month's worth of quits, not realizing how volatile and how noisy the data was, and arguing that was a trend. And this was the supposedly sophisticated chairman of the Federal Reserve citing noisy data as though it meant something.
That to me is always fascinating because you think the smartest guys in the room are falling for the same noisy data that shorter term traders and investors are falling for. Now, I'm curious, just given your observations over time, because you used that word exactitude earlier. Has the data become more precise, more exact over time, just because of technology, because of sources of information? Or, is that noisiness factor still as large as it was in decades past?
Yeah, well, exactitude is one word. I, as I used to put it, the market expects the economic data to have the finality of a market close. They think, the market closed at whatever price, whatever value the U.S. stock was at, or whatever value the Dow Jones was at, and that doesn't get revised. That's not an estimate. That's a price. It's a market close. And so they analogize that with the economic data. Actually, probably the data are a little bit more troubled. And this is something I should know more about and would have known more about had I been writing for Barron's. But I believe that the lockdowns created a lot of dislocations in terms of the ability of the statistical agencies to track data. In particular, for example, the unemployment rate is based upon much of it is door-to-door surveys. A lot of it is phone calls, but a lot of it was door-to-door surveys. And I believe that those had to be stopped. And so when a method changes with respect to gathering data, then the data itself could have discontinuities that could be troubling. And I don't know how far the statistical agencies have gotten with being back to where they used to be in the way that they gather data, so the same kind of, so to speak, supply chain disruptions that happen in the broad economy, I think have happened with the data. And I haven't read anybody extensively writing about this. I guess had I been still at Barron's, I would have investigated it closely. See, one of the things you want to do that I did is speak with a lot of people at the statistical agencies. What was interesting about most of them is a lot of them were pretty smart. Some of them are quite smart. And most of them had some time on hands, and they were perfectly happy to talk to a columnist like me and talk fairly candidly. They weren't that afraid of losing their jobs or being wrong. And so you could find out a lot about what was really happening with the data if you spoke with people rather than just read the press releases. And so I did that a lot. And probably I could have gone to Washington and spoke with them about the problems they were facing, and gotten a better idea of how they were coping. So again, I think there were supply chain disruptions in the data, and that is reason enough to have to wonder whether the data are as good or robust as the data used to be.
I want to go back to that viral video that you mentioned, that debate in terms of socialism versus capitalism. I want to relate that a little bit to the era of zero interest rate policy and where we are in terms of the culture. It's my belief that zero interest rate policy is more likely to result in socialist policies than not, because the cost of capital is nothing, right? I mean, it's a lot easier to put out policies that aren't really capitalist in nature if they're funded by with no cost, right, through zero interest rate policy. I'm just curious if as you look back on the last decade and ZERP and QE and all these extraordinary actions that the Fed did, do you think that we've moved to a more socialist type of system because of this Federal Reserve enabling that type of dynamic?
Well, that's a valid enough point that you make. Sure, obviously, zero interest rates are absurd, and it used to be often bad enough. Back in the early aughts when they were at 1%. We don't really know where the market interest rate would be. There are attempts to guess at it. There's something called the Taylor rule, where John Taylor developed a formula whereby he thought he could approximate what the interest rate would be. There was another attempt to do that, but really we don't know. Just like if we had the Federal Reserve controlling the shoe market or any other market and setting the price, we wouldn't know where the real market price should be. It's possible that the valid market rate was interest rate is lower than it used to be, and was lower than it used to be. Let's hope, because we hope the disruptions that the Federal Reserve has created aren't going to be awful. You're certainly right that historically, as a matter of fact, socialist economies didn't have an interest rate because they didn't. They just allocated the money that they printed, and there was no charge. They didn't even have an implicit interest rate on capital. Although I gather actually that when they experienced some bumps, there was a learning curve, and by the 1970s, 80s, social economies actually did introduce a kind of a implicit interest rate, a charge, some kind of like charge to capital that an interest rate essentially is, a charge to the borrowing of capital. But you're basically right, of course, that a zero interest rate means that it becomes very difficult for the market to allocate capital to the more credit-worthy borrowers if everybody's at a zero interest rate. So it definitely does move in that direction of socialism. And in addition, it's extremely potentially a problem for the stability of the economy. And there are, of course, those among my Austrian colleagues who are predicting that what we're in for is going to be the mother of all downturns. Certainly, David Stockman is predicting that, probably Peter Schiff. And I've accused both of those guys of being stopped clocks. They usually see a disaster right around the corner year after year, and it doesn't always happen. And so, my niche, I guess, is to actually emphasize that the capitalist economy, or the remnants of the capitalist economy, are more robust than they tend to give it credit for, and that the economy doesn't always collapse and doesn't always tank. But certainly, I think that they could be right that we're in for a very nasty recession, given the distortions of the 1% interest rate that you mentioned. So that of course gets back to what does the data tell us now, and about where we are. And certainly, unfortunately, I'm going to start sounding like those two-handed economists. I believe that the signals we're getting from the data, including the stock market, are very ambiguous. Most likely, we're due for a recession, but whether it's going to be the sort of recession that Schiff and Stockman are predicting, I'm not sure of. And so I probably can't be that helpful about that, but maybe we could talk about it a bit.
No, but hold on. That I like that you made that point. The signals of the stock market. So
Yeah.
The stock market was supposed to be a discounting mechanism of the future.
Yeah.
Now, right? I mean, and the Federal Reserve itself would probably admit this as through the wealth effect, right? It's no longer a discounting mechanism. It's a way of driving the future because a lot of wealth comes from the stock market, and then obviously housing as a relation related to that. I guess it's something that's just interesting to think through. Has the predictive power of the stock market as it relates to the economy gone down, gotten noisier because it's no longer a discounting mechanism, but rather a driver?
I'd have to differ. I think it was always a driver. You raise an intriguing question. I'll put it that way. Another way of that I see it is that we like to look to the stock market for some information about where the economy is going. The ideal argument, for the stock market as a great leading indicator is that it is sort of like a bottom-up evaluation that ideally, at least according to legend, a lot of it consists of people looking closely at the prospects for thousands of different capitalist firms and valuing the stock in accordance with their specific analysis. And so this is like a bottom-up analysis that then adds up to the stock indexes and where they fluctuate. And so this should be able to give us information and insight about the future. I'm not sure that I agree with you about the wealth part of it being a distortion, because these analysts, these people are motivated by wealth. They want to invest in companies that do well. Warren Buffett was famous for supposedly uncovering not only using arbitraging with taxes, which is another story about him, but being able to buy undervalued companies and bidding up their price. So presumably, and that's motivated by the desire for wealth. But the way I would put it is that the other part of the stock market is that there's a lot of information that just indexes the stock market. A lot of investors don't really look closely at companies. They just look at the broad market. In addition, a lot of investors and a lot of analysts, instead of actually looking to their own insights, they look to the broader economic data for what they think should happen, and that therefore, instead of actually bringing new information to the party, they just become mirror images of the information that they're getting from an already distorted data mill. It reminds me of the old phenomenon of the newspapers printing a series of stories and then printing follow-ups that say that a whole lot of thought leaders agree with the stories that they've just written, but in fact, the thought leaders agree with the stories because the thought leaders read about it in the newspapers. So it becomes a kind of a mirror image kind of analysis. So given the distortions and then the potential argument that many of the individuals who value stocks aren't very good about it in the first place. So maybe they're not very good at the particular stocks, and maybe they're overly impressed by the economic data, and in that sense, they're just a mirror image, and so they're not really bringing anything to the party. Paul Samuelson, an economist I don't admire, who was sort of the dean of the mainstream, he made the famous quip that I forget the number he chose in particular, but the famous quip that the stock market has predicted 8 out of the last 4 recessions. What is interesting is that at least we know that there's always a bear market, or practically a bear market, before a recession begins. But of course, those bear markets, those declines, have been for years filled with false signals. Samuelson was speaking about this, at least maybe close to 50 years ago, that the stock market often predicted the next recession, but just as often it was a false signal. The stock market was declining and the recession didn't happen. Hence his quip, it's predicted 8 out of the last 4 recessions. So here I've given you sort of on the one hand, on the other hand answer. I'm not sure I agree with you about the wealth part of it. I guess I tend to think that because there is so much broad market analysis, of the stock market based on economics, too much indexing, the stock market is probably not as valuable a leading indicator of what's going to happen, even though it was always a flawed leading indicator in the past. Perhaps you know that the leading indicator that has the fewest false signals is the yield curve. The Almost any measure of the short-term interest rate compared to the long-term. The short-term interest rate should be lower than the long-term interest rate, but then when the yield curve inverts, the short-term interest rate goes above the long-term interest rate, like, for example, the 3-month Treasury rate over the 10-year. And that inversion of the yield curve, the negative, the 3-month minus the 10-month goes negative. If you look at that on a graph, then it's the most robust indicator of an imminent recession, and it has indeed been negative. Most measures of the yield curve have indeed been negative for the past few months, and so one would think with that, based upon that, it's not usually a false signal that most likely we are in for a recession, even though a few months ago there was a fair amount of doubt among forecasters that I had some respect for. They thought the economy was going to pull through. I think they're a lot less confident now, given the bank failures and given some of the other numbers.
You use that term indexation quite a bit.
Yeah.
I wonder if you think that the broader move towards passive, that indexation point, if that's maybe another form of socialism. And I say that because
Socialism?
oh,
God.
yeah, no, and I say that purposely, right? Because for capitalism, you need to have fundamental analysis to determine what company is ultimately a winner or loser, to not have co-movement among stocks in an index.
Well, I wouldn't go as far as what you just said. Did you say a form of socialism? Is it?
Well, yeah, I mean, basically, the idea there is that if capitalism is about weeding out the winners from the losers, everybody ends up being the same. Stock prices tend to move the same, so fundamentals don't matter in an index, which is not capitalism.
Yeah, well, I wouldn't be so hard on the indexers. I may even have overstated the point that indexing is distorting the stock market's ability to be any kind of independent source of information about the future. Certainly, it's legitimate enough to treat stocks as just an asset class and say that and retired people, for example, or many investors, that this asset class has a certain sort of performance. That's a capitalist enough decision, and to say that that I'm not good enough. And of course, as you know, classically, most analysts aren't good enough to pick those stocks that are going to do better than the broad market. Only a handful of analysts and investors seem to have been good enough to be able to do that. But on top of that, you'll always get, hope springs eternal, you'll always get people who will analyze stocks and want to and actually just enjoy playing the game. What I'm getting at is there was this feeling that with all this indexing, we're never going to get anybody else trading the markets. Everybody's going to be indexing, and nobody's going to be able to tell the difference between one stock and another. But my argument is that that's probably an overrated fear. There are always people who read Barron's, who read company stories in Barron's. This company is better than other companies. There are always people who want to analyze stocks by looking at the ones who'll do better than the other stocks will do, or not nearly as badly as the other stocks will do. Pick the winners versus the losers. So there's always plenty of that, and I don't think then there's anything so terrible about somebody saying I buy stocks as an asset class. I just buy stocks as an index, and of course there are many index funds, and over the course of any 15 to 20 year period, by the way, this goes back to 1871. I wrote about this with Barron's several years running. That from 1871 to the present, I shouldn't push 15-year periods. Certainly 20-year periods. Any 20-year period in the stock market, if you reinvested dividends tax free, which you can do through a retirement fund, through a 401k or IRA, you reinvest the dividends. The stock market beat inflation. And on average, over the long run, over 30, 40-year periods, it beat inflation by about 6.5% a year. nominal returns of 9.5% to 10%, and inflation-adjusted returns of 6.5%. So that's very seductive for somebody who wants to save for his retirement, but who doesn't want to play the stock market. So I would treat such people with respect and not call them socialists.
Just for the remaining couple of minutes here, again, everybody, please make sure to follow Gene Epstein on Twitter. Gene, maybe just for the last question, I'm just curious, given these conversations you host through the Soho Forum, what have been some of the more interesting debates or topics that you guys have put out there?
Well, I would mention in particular the one that we just hosted between the African-American economist for Wall Street Journal, Jason Riley, and NYU professor Nikhil Singh. And this had to do with debating the best chances for upward mobility for blacks. And it was a very lively debate, very well attended. Jason Riley argued the affirmative. He took an affirmative resolution that blacks should make the most of the opportunities the American society and the American economy already offers them, and that progressive politics is only impeding the progress of blacks, where Nikhil Singh took the negative. We do Oxford-style voting at Barron's. Oxford-style voting asks the audience to use their smartphones, in fact, where we could give them an app. The smartphone asks them to vote yes, no, or undecided on the resolution before the debate begins, and then to vote yes, no, or undecided after the debate ends. And so that would mean that if you get a lot of votes in your favor initially, that counts against you, because the only way to win the debate is to move the needle. What's the difference between the yes votes initially and the yes votes afterwards? And based on that, if you're defending the affirmative, did you win or did you lose? And so it's a very fair way of judging a debate, although hardly a decisive way. It's just a game, but of interest nonetheless. Jason Riley won the debate by a fairly substantial margin. So I would recommend that debate. If you go into thesohoforum.org and go into past events, you will find links to all of our debates on YouTube. And we've had about 75 debates since I started the Soho Forum in the fall of 2016. And if you go into the Soho Forum podcast, the Soho Forum podcast, which would be on anybody's smartphone, available on anybody's phone, you can listen to any of the debates on podcast. As I mentioned, I've done a number of debates, and I debated Rick Wolff, who was a socialist. I've done 2 other debates with socialists. 2 of them had 100,000 views on YouTube. My one with Rick Wolff got nearly 6 million. It's up to like nearly 5.9 million right now. It keeps climbing, probably because of his celebrity. But I also want to recommend to anybody who's going to be in New York City on April 20th, that's 2 weeks from today, the evening of April 20th, at the theater, the Sheen Theater at 18 Bleecker Street in downtown Manhattan, we will be hosting a debate on the New York Times 1619 Project. That's the book and the Hulu series about the history of slavery. And a Professor Woody Holton is going to defend the veracity of that series on slavery. It will be opposed by Phil Magnus. And I'm very excited about that debate. That will be April 20th. And if you go on our website, thesohoforum.org, you can buy tickets to it. My debate society has a 2-fold mission, not only to host debates of interest to libertarians, but to have a party. We have a party afterwards at my loft apartment, catered by my wife, Hisako, and that's just 2 blocks uptown from the venue. The debaters usually come to that after party. You can talk to the debaters and learn more. You can meet people. And so it's always a very exciting evening. Certainly for me, and I believe for others, we've been doing quite well. We sell tickets for $24, and the reception costs $8. It doesn't nearly cover our costs, but certainly people are happy to pay $24. It's not very expensive for sort of a live evening of theater in downtown Manhattan. So go into thesohoforum.org for all that information.
Thank you, Brett, for joining, doing another space in literally 2 minutes. Thank you, Gene. Really do appreciate it.
My pleasure. Thank you. Bye-bye.